Today, Travis owns three businesses: a cafe, a cleaning company, a small property. Every month, money comes in. Life is good. Travis isn't rich, not yet. But he's built something real, something that pays him without him having to answer to anyone. He wakes up in the morning and the businesses are already working. Then one day, a customer at the cafe slips and falls. They sue. And because Travis set everything up under one name, the lawsuit doesn't just go after the cafe. It goes after everything: the cleaning company, the property, his savings. Every asset attached to his name becomes fair game the moment a court judgment lands against him. Travis loses it all. Not because the business failed, not because he made a terrible decision, because the structure was wrong. Now rewind. Same Travis, same businesses, same lawsuit. But this time, Travis had done one thing differently before any of this happened. He built a holding company. The lawsuit lands. It hits the cafe, and it stops there. Everything else is untouched. The cleaning company keeps running. The property stays in his name. His savings are fine. He pays the legal costs, moves on, and by the following year, the cafe has recovered. That one decision changed everything. If you want to see how Travis did it, subscribe and keep watching. Most people who own more than one business make the same mistake. They stack everything under their own name or under one company because it's simple. And at the start, simple makes sense. You have one thing to worry about: one set of books, one tax return, one bank account. But simple has a cost. The problem isn't obvious when you have one business. It becomes obvious the moment you have two or three, and suddenly you realize that everything you've built is sitting in the same pile. One problem in any corner of that pile can spread to every other corner. A creditor chasing business A can look at business B. A lawsuit that wins a judgment can collect from your entire pile. A supplier you owe money to can come after assets that have nothing to do with the transaction that went wrong. You have what lawyers call unlimited exposure, and most people don't find out that's a problem until they're already sitting across from someone in court. The question isn't whether something will go wrong with one of your businesses. Something always eventually goes wrong. The question is whether that problem is contained or whether it takes everything else down with it. The holding company solves this. And the idea is simpler than most people expect. Instead of owning your businesses directly, you create one company whose only job is to own the other companies. That's it. This company doesn't sell anything. It doesn't serve customers. It doesn't manufacture products or run operations. It has no storefront. It just sits at the top of the structure and holds ownership in everything below it. That company is your holding company. The businesses underneath it, the cafe, the cleaning company, the property, are called subsidiaries. Each one is its own separate legal entity, its own bank account, its own registered name, its own set of liabilities. They operate just like any normal business. They have staff, they serve customers, they make and spend money. The only difference is who owns them. Not Travis directly, the holding company. The holding company owns them, but it is not them, and that distinction is everything. When the cafe gets sued, the lawsuit lives inside the cafe's legal entity. It cannot climb up to the holding company. It cannot reach sideways to the cleaning company or the property. They are separate boxes. The walls between them are legal walls. Not just accounting walls, not just naming conventions, but actual separate legal entities with their own rights and their own boundaries. A creditor can only go after what the entity they're suing actually owns. The cafe owns the cafe's things. The cleaning company owns the cleaning company's things. The holding company owns its things. None of them can be rated to pay another one's debts. This protection is real, but, and this is critical, it only works if you actually treat the companies as separate. Separate accounts, separate records, separate decisions. If you mix the money between entities, if you pay one company's bills from another's account, if you blur the lines between them in any meaningful way, courts can ignore the structure entirely. That's called piercing the corporate veil. It's the mechanism courts use when they decide the separation between companies was never real to begin with. And when that happens, the protection disappears as if it was never there. So the rule is simple: build the walls, then honor the walls. Every time, without exception. Now here's something most people don't know about control. You don't need to own 100% of a subsidiary for your holding company to control it. You need 51% of the voting shares. That's enough to control every major decision, whether to grow, to sell, to bring on a partner, to merge, to shut it down. Which means Travis's holding company can control 5 businesses while only owning half of some of them. Other investors or partners can hold the remaining shares. Travis still calls the shots on strategy. He keeps authority without having to fund everything entirely from his own pocket. That's a feature, not a limitation. And the structure scales. Today, Travis has 3 businesses. In 5 years, he might have 8. Every new subsidiary that gets added sits underneath the same holding company. The structure doesn't get more complicated, it just gets wider. The same logic that protects 3 businesses protects 10. The holding company sets the strategy. The subsidiaries handle the day-to-day. The holding company doesn't need to know how to make a great coffee, or clean a building, or manage a tenant. It just needs to own the companies that do those things, and appoint people who can run them. Think of it as the difference between the person who owns the chess pieces and the pieces themselves. The pieces move. The player decides where. So how does Travis actually make money from this? His subsidiaries operate. They generate profit. and that profit gets sent up to the holding company in the form of dividends. The holding company receives that income and decides what to do with it. Reinvest into one of the existing businesses, use it to acquire a new business, hold it as a cash reserve, or pay it out to Travis as the shareholder of the holding company. The money always flows upward. The risk always stays contained below. But here's where the tax side gets interesting, and where a lot of people start to see why serious operators prefer this structure. In many countries, when a holding company owns enough of its subsidiaries, it can file what's called a consolidated tax return. The details vary by country, and you should always get local advice before making decisions about structure. But the principle is powerful. If the cafe had a bad year and lost money, and the cleaning company had a great year and made money, the loss from the cafe can offset the profit from the cleaning company. You're taxed on the net result of the whole group, not each business individually. A loss in one part of the structure doesn't just disappear, it actively reduces the tax bill across the rest of it. That's not a trick. That's not aggressive tax planning. That's the structure doing exactly what it was designed to do. The whole point of grouping companies under one ownership umbrella is that the group is assessed together. There's one more layer that most people miss entirely, and it might be the most powerful part of the whole structure. A holding company can own the assets that the businesses use, the equipment, the intellectual property, the brand name, the logo, the systems, the processes, the real estate, and then lease those assets back down to the subsidiaries. The subsidiary pays rent or a license fee to the holding company. That payment is a deductible business expense for the subsidiary. It reduces the subsidiary's taxable profit. And the assets themselves sit safely at the holding company level, completely removed from the operating risk of any individual business. Here's why that matters. If the cafe gets sued and loses, the judgment is against the cafe. But the cafe doesn't own its espresso machines or its lease. The holding company does. The cafe was renting them. The creditor can only go after what the cafe actually owns. The equipment stays. The brand stays. The real estate stays. This is how serious business owners separate the things that make money from the things that are worth keeping. The operations carry the risk. The holding company holds the value. This isn't a strategy invented by lawyers for billionaires. The biggest companies in the world are built exactly this way. In August 2015, Google announced it was restructuring into a holding company called Alphabet Inc. The change was completed on October 2nd that year. The core Google business, search, YouTube, Android, advertising, became a wholly owned subsidiary of Alphabet. The riskier experimental projects, self-driving cars under Waymo, life sciences under Verily, biotech under Calico, were each spun off into their own separate subsidiaries underneath the same umbrella. The reason was simple. Google's advertising business was generating enormous profit. The moonshot projects were burning through cash and might never work. If those projects failed, Google didn't want that failure anywhere near its core business. The holding company structure meant that each bet lived in its own box. A billion-dollar failure in one subsidiary stayed inside that subsidiary. Google's former CEO Eric Schmidt later confirmed the structure was partly inspired by Warren Buffett's Berkshire Hathaway. Berkshire Hathaway is arguably the most famous holding company ever built. Buffett started with a struggling textile manufacturer in 1965 and spent the next 6 decades acquiring businesses and leaving them to operate independently underneath the same ownership umbrella. Today, Berkshire owns more than 60 subsidiaries. Geico, one of the largest car insurers in America. Dairy Queen, with thousands of locations worldwide. BNSF Railway, one of the largest freight rail networks on the continent. Berkshire itself doesn't sell insurance or serve ice cream or run trains. It holds the companies that do. And because each one is a separate subsidiary, a catastrophic loss in one of them doesn't threaten the rest. The same logic that protects Alphabet's moonshots protects Travis's cafe. The scale is different. The principle is identical. So can Travis actually build this? Yes, and the costs are manageable, not prohibitive. You pay formation fees for each legal entity. Depending on where you are, that might be a few $100s per company. You maintain separate records for each one. You need separate bank accounts and clearly written agreements between the entities, especially if the holding company is leasing assets down to the subsidiaries. Done properly, with good legal and accounting advice, the ongoing cost of maintaining the structure is small relative to what it protects. The trade-off is not complicated. The cost of setting it up is a fraction of what you lose if one lawsuit takes everything down. There's a common objection at this point. People say, "I'm too small for this. This is for big companies." And that's exactly what people believe, until the lawsuit arrives and they realize the holding company structure would have cost them less to set up than the legal bill they're now facing. Travis started with one business. He built a second, then a third. At some point, he had a choice: keep everything connected and exposed, or build the structure that separates them. The moment you have two businesses worth protecting, you have a reason to think about this. He chose the structure. Now the holding company sits at the top. The businesses run underneath it. The money flows up. The risk stays contained. The assets are protected. And every new business Travis adds just becomes another subsidiary, another box underneath the same umbrella. One company that owns companies. That's all a holding company is. And that one decision is the difference between Travis losing everything and Travis walking away fine. If you were building your own holding company right now, What three businesses would you put underneath it? Drop them in the comments.